Peter Rose, Longwood Currency Trading. It's early October of 2021 in New England. The leaves are changing, and so do currency prices. We're just going into our fall foliage season, so you can see the colors are just beginning to change. Even back in the woods, back there, you can see just the slightest oranging and yellowing of the leaves. It's really pretty. Back in here, looking back up over the side of the house. And even here, because of the cold nights that we've had, we've even started to drop some leaves. Speaking of dropping, there was a huge branch that had fallen off that tree and was trapped, and I had to push it down, and it banged me in the head. I'll show you the pieces of that tree because I won. And there it is. I won. Tree bangs me in the face. I cut all the branches up. I win. Part of the winter preparedness, the change from season to season here, particularly going from your fall season into winter, is to make sure you've got your wood pile squared away. So part of my task the other day was to get the tarps on the wood pile, and I can see the wind has already blown a couple of the things off of there, so that's not as stable as it should be. And here's the other pile, and that's all ready to go. So as we transition from season to season, and we get this beautiful foliage change here, that's all in accord with the process of nature. And so price action should be that way too, because price action is the result of us as human beings executing orders that other human beings have put out. You know, companies wanting to exchange currencies so that they can contract commerce between their two countries. There's order to that. It isn't chaotic. Although the individual movements of an individual price tick, from a mathematical standpoint, is random, right? It's 50-50 jump ball whether it's going to go up or going to go down. But in the long run, again, according to the laws of mathematics expressed in Brownian motion, the physics of Brownian motion, there is some order within chaotic systems. And so, though it's random as to which institutional trader is going to be executing trades or whatever against his particular order book and how many clients are coming in, that's all a chaotic system. There's no order in that. And yet at the same time, because there are requirements that the customers are putting onto those brokers, and those requirements tend to be pretty similar to everybody else's requirements, that all of a sudden you can change a random system, a chaotic system, into one of predictability, probabilistic analysis to determine predictability for a price action. The same way you can't tell what an individual leaf in a river is going to do. It could go with the current or against the current or all that other kind of stuff, but as a whole, all the leaves that are in the river are going to go with the flow of that river. So from a statistical and probabilistic standpoint, you can say that particular leaf is going to ultimately go in the direction that the river is going in. So out of the chaos is an expression of order. And we look at the nature around us, and this statement of, get back out here, walk down the hill here, Peter. This statement of random seasons changing, weather patterns, that's all totally just random. And yet here we have a situation where the leaves are beginning to change in response to this random weather pattern, which every 3 days gets 1 degree cooler as we go from fall into the winter season. So we're taking random stuff and we're creating order out of it. So the leaves are changing, and they're changing in a random fashion, and yet at the same time, in the distance there, through the power lines, you can see that you can look at the tree and you can say, oh, the trees are just in early changing period because of the color. Well, the colors are being produced randomly based on random temperature changes and stuff. And so we look at price action on a chart and we can say, oh, wow, this stuff is all over the place. And yet at the same time, if we know what to look for, we can take that chaotic, random buzzing around and either through mathematics, which is stupid to try to do it that way. It's proved through mathematics, but you don't need the mathematics to look at a chart and say, oh, it's trending. Well, what's the probability that the trend is going to continue? It's going to be based on factors of how long it's already been running, what the momentum of the individual candles have, what the time of the day is, what time frame you're looking at, and all these different things that we as traders have to take into consideration. And yet you don't take them into consideration other than, you know, you've got 6 months or less of trading. You have to have a checklist, like an airline pilot has a checklist before he takes the plane out. Boom, this is done, this is done, this is done, this is done. And so when you're starting out in trading, you have to have that checklist. But as you gain in experience, you eyeball the thing and you see the change. And you know that that change is not random, it's not chaotic, it's predictable, and it's extensively predictable from a probabilistic standpoint. Not through a mathematical process, but just one of looking at the trees around you out in the back there where they've begun to change more just because of the dampness and at night the cold changes and the temperature variations are a little bit more. So you get more color changes out in there than you do like right here, which is up in the hill and kind of out of that swampy area that's down there, because there's a brook that runs down through there. So we will look at the reasons for this change in the color, and we could look at a bazillion different things. Is it important to know all those things in order to see that the colors are changing and that the leaves are going to be dropping off? No. Just don't stand under the tree when the leaves start to drop off, or they won't find you till the spring. So when you're evaluating your trade entry, whatever analysis that you're going to do in order to evaluate a trade, you need to be sure that that evaluation takes into consideration the fact that you're dealing with random systems, you're dealing with chaos, and yet out of that chaos is predictability because of in price action, it's the predictability that the order flow is coming from, 85% of it anyway, is coming from the large institutional trader who is conducting business on behalf of clients in different countries. So look, what's the trigger that makes the randomness go to some type of predictability? Well, it begins if you look at each individual country's economy at that particular time. And the economies are generally foundationed upon the interest rate that the particular country is paying. Of the country, whatever, in the United States, it's the Federal Reserve that sets the interest rate that the banks can make on their deposit money, which in turn means that they go up a couple of points from that to lend it to some of the member banks, and those banks bump it up, and it goes on like that. So there's a reason why mortgage rates are at a certain level, or car prices that are at a certain level. You know, right now we're in a housing market and inflation price, and everybody says, wow, things are just going crazy. I know in the UK things are going really nuts in certain parts right now, as it has been the case in areas like California, New York City, Boston. Even in little areas where I live in, prices have gone up probably 20%, 18% in the last year. That's a lot, when the average might be 8% a year. Here, on the coasts. If you go inland, price fluctuations, you might go 5% a year. And there's economic reasons for that. So you look at the different countries and what's the economics there. Somebody is going to put a $4 billion order in for one currency so they can buy auto parts. Okay? Well, there has to be a limit to what they're going to be willing to pay for the currency that they're trying to buy in order to buy those auto parts, right? Because if you have an auto part that's worth, and worth is what somebody is willing to pay for it, but the characteristic price of that engine part, let's say, is $100, and so you have thousands of these parts together, and so you price all those parts together, and you add on the labor, and you add on the plant facility charges, and boom, you come out with the wholesale price of the car. And then the retail guys mark it up from there, a certain percentage. That's how things get priced. But it's got to start with the guy who's trying to do that $4 billion order for those $100 valued parts. Well, do you want to pay $300 for that part? No, you're not going to pay $300 for it. And so you're just going to sit on the side. You're not going to buy it for $300. You might be willing to pay $125 for it, or that's probably way too much. You might be willing to pay $103 for it. You'd be tickled to death to get $98, have to pay $98, but you're willing to pay $103. That's the spread. And so if you look out on a currency price chart, we're not talking about hundreds of dollars or whatever. We're down at the 10,000th decimal point, where one pip will equal $10 on one full lot. So if you're gonna raise your price $10, I mean, holy crap, $10 on a I mean, that's out at the right at the front end of the price point, at the 10 level, not at the 10,000th level. And so you don't want to be paying $5 million more for all of those $100 parts that you're paying $103 for. You'd rather pay the $98 price. So the price that you're telling your institution that you're willing to trade within trades within those bounds. And that's where you can find out what's going on by looking at the daily ATR, for example, because that's the actual pricing over the last 14 days that commerce has been conducted at. And so the next price is going to be pretty much in accord with that daily ATR, because that's where the customers who are ultimately transacting this currency, that's all they want to pay. And the guy on the other side is saying, well, I'm not going to sell this thing for less than this. And so you get this tight bound range, which is manifest in the ATR on a daily basis, on a 5-minute time frame. It doesn't make any difference what you're talking about. But that's what changes the chaotic system and randomness into one of predictability if you understand the economics of what's happening. If you have a country whose interest rate is going batshit, that's going crazy, they're not going to be willing to pay very much for their inventory, because people have to store that stuff. And the cost of storage sometimes could exceed the actual purchase price, right? I mean, you could see that happening. So you have to be very careful about what you're going to be willing to do when you're trading in that market. And so if you have one country with a really high interest rate and another country with a really low interest rate, the country with the high interest rate, their price is going to be going up, because somebody investing in that country is going to make a higher interest rate return on their investment than they would in the country that has a lower interest rate. And yet at the same time, the higher interest rate damages the actual manufacturing and production process, because the cost of goods goes up cost of labor goes up, and then they got to charge the customer more, and the customer then can't afford to buy the house that he wanted to buy, and it becomes a very problematic issue. So if you're going to trade currencies, you don't have to know fundamentals, but you better know interest rate theory, and you better know that there's two countries on each side of that transaction with different economies, with different needs, and the manifestation of all that is being shown in a non-random, non-chaotic manner in a predictable way by looking at the daily ATR. I wouldn't go out to the weekly. I mean, you're looking back 14 weeks. Now, it's true that the order cycle for big manufacturing stuff may be a year. So you go out on a monthly chart, you go back 14 months or whatever. But the actual transaction, when you actually go into the market to say, okay, I need $4 billion worth of this shit, that happens today. And the broker says, well, I can't dump $4 billion in here. I'll do it in 400 or $500 million chunks until I bring that price way, 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 way up, and then I'll sell $1 billion worth, and it'll just collapse the market, and that's where he picks up his liquidity, so that he stays within the boundaries that the client has said. I'm willing to pay this much. I'd really like to get this much. And the guy that's selling is saying, this is the absolute bottom price I'm willing to sell for, but I hope to get this price up here. And so that's that supply-demand. Forex is not a supply-demand market, but it's what is represented by price action that is supply-demand, which therefore makes price action in the currency markets supply-demand dependent, and that's what creates the probabilistic predictability of what price should do, might do, or could do, as opposed to, well, it won't do this. And that's an expression in the size of the candles in relationship to the ATR. You have to be very careful how you judge that and how you balance it. But that's what you do. And as we look at the leaves here in New England, with the colors changing as fall season, prices change as well, all in accord with the process of nature. And I hope I get this camera right and it's not cutting my whole body off as the last couple of videos that I've done. I didn't used to have this problem, but I guess I got to get used to the new selfie stick that I have here and where that's at. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. And if you happen to be in an area with the seasons changing, go out, smell the air, and enjoy it, because then you'll be ready for the next season.